Yeah, and I've told people about this, is you do not get the kind of crazy upside you get in Bitcoin without the downside volatility.
Yeah.
32% corrections are very standard. In 2017, I had about 4 of them. In 2013, I had a 45% correction. That needs to be taken in context with the upside. So people need to understand what this asset looks like. It's very volatile, but it has a very skewed risk reward. So I've been personally adding, so over time, and I've talked about this, I added Ethereum and then I've added more Ethereum as I think that the people start moving out the risk curve. So Bitcoin is the safe asset. Ethereum is the next least risky asset, but has a bit more risk characteristics. So in a bull market tends to outperform. And then the next phase of that is the alts, which are the smaller market cap tokens and coins that tend to be very speculative. Mm-hmm. But within them, there's actually some very decent products, projects, protocols, tokens that usually outperform massively. So if I think about how I think about it, I think Bitcoin could do another 10x from here over the next 12 months. Ethereum could do 20x. You can see that in the Bitcoin Ethereum chart itself. If it breaks this 0.04 level, it's at 0.037 right now, breaks that, that's a big inverse head and shoulders rounded bottom. So that would suggest Ethereum outperforms. So it could do double what Bitcoin does. Some of these alts could do 50x. So, but they're riskier. So you have to allocate smaller amounts of capital. The wrong game is what many people do is like, they're going to go up more, I'm going to put all my money into those. No, that's how to go broke. Yeah. The way is to think, can I get some extra alpha, some juice out of my trade by going slightly out on the risk curve and changing my asset allocation a bit? So that's how I think about it. Trying to keep a portfolio which is mainly Bitcoin, a good chunk of Ethereum, and then a small speculative thing that could pay off well if it works. But if it doesn't work, it doesn't hurt me much.
You were talking earlier about the hardest lesson to learn in investing, and I thought this is a fascinating.
Yes, this is true, because I've been thinking about this. What have I found the hardest to do, and what has almost everybody, particularly in macro land? Macro land, we're all cynics. That's our game is ambulance chasing. We look for we hear the sound of the ambulance, we try and, get in front of the trend, particularly when it turns. What is interesting is everybody has to learn how to enter a trade, how to put stop losses, how to manage your risk, how to scale out of a trade, take some profits. All of these things, right? These are standard trading things. But a couple of times in your career, you catch an exponential trend. And exponential trends are so difficult to deal with. So Bitcoin is one of them. Everybody wants to tell your position that you're wrong. This risk is going to happen. This risk is going to happen. You're going to lose it here. And all of those are real risks. And somehow you need to filter all those out without feeling sick and saying, no, I think it's going higher, and here's my reasons. And that is the hardest thing I've ever seen anybody do. It's really hard. Macro people don't do it very well because they always get cynical too quickly. Some people, people look at stocks like Microsoft or Amazon and say, look how much they rose. Virtually nobody, unless it's in a passive vehicle or some portfolio they didn't look at, ever rides those. Because at some point, Amazon's going bust. It's a terrible company. Look at its PE. It's trading on a PE of 800. You've got to get out. And the market screams, get out, get out, get out, get out all the way. And the key to making the big bucks is not getting out. And that's terrifying because your fear is always, this is all going to go horribly wrong. And it was interesting. It's fighting the counter narrative, or in the crypto world, they call it FUD. What's it? Fear, uncertainty, and despair. Doubt. So I've been a bond bull for basically my entire career, 30 years. All I've had to do is, Travis and I were laughing about this over Twitter, all I've had to do that whole career is do this, is you have to stop all the inflationists going, inflation is going to break out, wage inflation is going to, and it never happened. It's cyclical, then it disappears, and bond yields keep falling. But I've had to fight narratives for for 30 years in this. So I know I can do it in bonds. I'm trying to do it now in crypto. And I've seen a few friends of mine who've ridden, 100Xs. Really difficult to do. It's I think the most difficult trade of all.
Yeah, look at that chart on the 30-year Treasury yield. If you just go back to 1980 and just watch that yield.
It's just done this. It's just a one-way trend.
Yeah.
But even if you look at the Fed and Wall Street forecast, every year they do this. They're going, yields are going up, and they don't. So you have to fight the narrative, because everyone calls me up, calls me an idiot. Usually at the beginning of the year, when everyone says yields are going up, I'm like, they're probably not. And then what happens is I get called an idiot, and then yields fall again. And you can see it. It's a stair-step pattern as well. It's pretty clear. It's a big channel, stair-step, which is the cyclical part. And then as everyone goes, yields are going to break out. Remember Jeff Gundlach, yields are going to 6%. It's all the same thing. Everyone looks at that channel and projects a breakout of yields to the upside, and they never do. And I still don't think they're going to. And still we're hearing the inflation, MMT, currency printing, inflation. Right. And all I look at is that chart and say, that's the chart of truth. It's never let me down in 30 years. My guess is it lasts a little bit longer.
Yeah, you could have been a fixed income analyst in 1981 and said, this is my call. I predict 30-year Treasury yields are going to fall, and that's going to happen for the next 40 years. And
isn't that Schilling? That was Schilling, right? That's what the bet he made. He made one bet, which was bond yields are going to fall, and he's got it right all the way through. So, but yes, and really, that's the biggest source of returns for the macro hedge fund industry. Because what's amazing about bond markets is they are low volatile, massively liquid, trade 24 hours a day, and you can get huge leverage, and it's massively trending. It's like that's the world's perfect trade, and they follow the economy. So it's not like you're trying to figure out the behavioral psychology, really. It basically follows the economy. So it's been a great source of returns. Problem is sure, maybe I'm right, bond yields fall to 0 or negative 0.5%. That's one last push, and then it's dead. There's nothing left. I talked about this with Ed last week. The kind of death of macro is real. That's the message I'm basically getting from the friend of mine who's the fixed income derivative guy. He's like, what am I supposed to do? Try being a Japanese government bond salesman for the last 20 years. You've had no job except answering the phone to the Bank of Japan saying, how many would you like today? That's it.